Hello there, and welcome back to Chronicle Keepers. If you're new here, you've found a quiet corner of the internet where history unfolds gently, perfect for those hours when sleep is just around the corner. Before we begin, take a moment to settle in. Dim those lights, adjust your pillows, get comfortable. Maybe grab a calculator so you can cry softly over current mortgage rates. Just kidding. Mostly. Tonight, we're exploring something that haunts the dreams of millions. The mortgage. That delightful arrangement where you agree to pay a bank for 30 years in exchange for the privilege of calling a pile of walls and a roof your own. Home ownership wasn't always this complicated. For most of human history, people built houses, inherited houses, or simply didn't have houses. The idea of borrowing money from a stranger to buy property and then spending 3 decades paying it back, that's surprisingly recent. And here's the thing, the old ways weren't necessarily better. In fact, they were often much, much worse. If you enjoy these late-night journeys through history, I'd love a like or subscribe, but only if it genuinely feels right. And I'm curious tonight, drop a comment below. Do you own, rent? Are you too terrified to even look at house prices in your area? You're among friends here. Let's journey back to when buying a house meant something completely different and somehow more terrifying. Before we can understand mortgages, we need to understand what came before them. And what came before was decomplicated, different. In many ways, far more brutal than signing a stack of papers at a closing table. Let's travel back, way back, to a time when the very idea of buying a house would have seemed strange to most people. In the ancient world, land ownership was not for ordinary people. Kings owned land. Temples owned land. Nobles and aristocrats owned land. If you were a common farmer, a craftsman, a laborer, you worked land that belonged to someone else. You lived on land that belonged to someone else. The dirt beneath your feet was not yours. This wasn't just custom, it was the fundamental structure of society. In ancient Mesopotamia, those same Sumerian cities we discussed when talking about taxes, property records were etched onto clay tablets. Around 3000 BCE, scribes were documenting who owned which fields, which orchards, which buildings. These tablets still exist. You can see them in museums. Humanity's earliest paperwork includes receipts, tax records, and property deeds. We were bureaucrats from the very beginning. But these property transfers were generally between elites, a wealthy merchant buying a warehouse, a temple acquiring farmland, a noble family consolidating holdings. The idea of an ordinary person purchasing property with borrowed money? That simply wasn't how the world worked. Ancient Rome had more sophisticated property markets. Real estate changed hands. Sales were recorded. Contracts were enforced by law. But these were cash transactions, or barter. If you wanted to buy a Roman villa, you needed the money, all of it, up front. Credit existed in Rome, certainly. Romans borrowed and lent money constantly. But borrowing to buy property, spreading payments over years or decades, that system hadn't developed yet. Here's something interesting. The word mortgage comes to us from Old French. Mortgage. It means death pledge. Death pledge. Not the most reassuring terminology for something millions of people sign today. The name refers to the deal dying, when either the debt is paid off or the borrower fails to pay. Either way, the pledge ends, in success or in loss. The term itself hints at how seriously our ancestors took these arrangements. This was not a casual transaction. This was life and death, prosperity or ruin. Now let's move forward to medieval Europe, the feudal era. And here, property ownership becomes even more complicated. In the feudal system, you didn't really own land. Not in the way we think about ownership today. The king owned all the land. In theory, he granted portions to his most powerful nobles in exchange for loyalty and military service. Those nobles granted portions to lesser nobles, and so on, down the chain. At the bottom were the peasants, the serfs, the people who actually worked the soil, grew the crops, built the buildings. They owned nothing. A serf was bound to the land. They couldn't leave without permission. They owed labor and a portion of their harvest to their lord. They lived in houses that weren't theirs, on farms that weren't theirs, in a world where the very concept of buying property was nearly meaningless. Even if a serf somehow accumulated money, unlikely but not impossible, they couldn't simply purchase land. Land wasn't freely sold. It was held, granted, inherited. It moved through family lines and political arrangements, not market transactions. What about wealthy merchants? Surely they could buy property, sometimes, but with difficulty. In many places, owning land was a noble privilege. A successful merchant might be rich in gold, but unable to buy an estate because he lacked the proper bloodline. Some merchants found ways around this. They married into noble families. They received special grants from kings. They leased land rather than owned it. But the easy conversion of money into land, the free market in real estate that we take for granted, didn't exist. And who was the largest landholder in medieval Europe? The church. Monasteries, cathedrals, bishoprics. The Catholic Church owned staggering amounts of property. Land was donated by the faithful, accumulated over centuries, rarely sold. The church was immortal after all. It could hold property forever. Some historians estimate that the church owned between 1/4 and 1/3 of all land in medieval Europe. Entire regions where every farm, every village, every forest ultimately belonged to ecclesiastical authorities. Inheritance, not purchase, was how most people came to hold land. Your father's land became your land. Your family's estate passed to your family's heirs. Generational wealth or generational poverty was the system. Now, lending did exist in the medieval world. Money was borrowed and lent. Interest was charged, sometimes. But it was complicated. The Catholic Church taught that usury, charging interest on loans, was sinful. A serious sin. Lending money and expecting more back than you lent was considered exploitation of your fellow Christians. This created a problem. Lending without interest isn't really sustainable as a business. Why would you risk your money for no reward? Enter the Jewish moneylenders. Jews in medieval Europe were often forbidden from owning land, forbidden from practicing many trades, pushed to the margins of society, but lending money that they could do. The Christian prohibition on usury didn't apply to them. So Jewish communities became associated with lending. They served a vital economic function, providing credit that Christian prohibitions otherwise prevented. This role made them essential. It also made them resented. When debts couldn't be repaid, the moneylender became the villain. The pogroms and persecutions that followed were partly fueled by this resentment. A dark chapter we shouldn't forget. Italian merchant bankers also developed sophisticated lending practices. The Medici and other banking families found creative ways around usury prohibitions, exchange rates that disguised interest, partnership arrangements that shared risk. In the Islamic world, different principles applied. The Hawala system allowed transfers of value across great distances without physically moving money. Islamic lending developed structures that avoided charging interest directly, while still facilitating credit. But none of these systems were quite what we'd recognize as mortgages. Loans existed, but they were short-term, repaid in months, not decades. They were personal, based on relationships, reputation, trust. They weren't specifically designed for property purchase. If you used property as collateral for a loan, the arrangements were crude by modern standards. You might hand over your land entirely to the lender until the debt was paid, or the lender might take the income from your land as interest, or you might lose everything if you missed a single payment. No grace periods, no foreclosure processes that took years, no legal protections for borrowers. The system was primitive, and it was brutal. So what did this mean for someone who wanted property? If you wanted to buy land, you generally needed full payment up front. Cash, barter, the complete value of the property, handed over at once. How many people could do that? Almost no one. Credit existed, yes, but it was informal, personal. You borrowed from family, from friends, from local merchants who knew you. The amounts were small, the terms were uncertain, the risks were enormous. If you defaulted on a debt, if you couldn't pay what you owed, the consequences were severe. Debtor's prison was common. You would be locked away not for committing a crime, but for owing money. Your family might be left without support while you rotted in a cell, unable to work to repay what you owed. In some places, debt bondage was the answer. You became a servant, essentially a slave, until your labor paid off what you owed. Your body became collateral for your debts. There were no standardized systems, no legal protections for borrowers, no regulated interest rates. Each loan was its own negotiation, its own set of terms, its own set of dangers. The wealthy could navigate this world. They had connections, reputation, assets to pledge. They could borrow from each other, from banking families, from the few institutions that existed. Everyone else? Property was simply out of reach. Property was concentrated in the hands of those who already had it. The nobility, the church, the handful of merchant families who had accumulated wealth over generations. For most of human history, owning a home was not an aspiration. It wasn't a goal you worked toward, saved for, planned around. You rented. You worked land that belonged to someone else. You inherited, if you were lucky enough to have family with something to pass down. The property ladder that we talk about today, starting small, building equity, moving up, didn't exist. There was no ladder. There were just the people who had property and the people who didn't. Generational wealth was the only path. If your great-grandfather was a serf, you would almost certainly be a serf. If your family held land, you might hold land. The circumstances of your birth determined your relationship to property almost entirely. This seems unjust to modern eyes. It seemed natural to medieval ones. The world was ordered by God, by tradition, by the way things had always been. Questions about why some people owned and others didn't were rarely asked. And here's something worth considering. If you could somehow transport a medieval peasant to a modern mortgage closing, show them the 30-year term, the fixed interest rate, the legal protections for borrowers, the ability to own property with just a small down payment, they would be astonished, not by the complexity. Well, yes, by the complexity too, but mainly by the generosity. The idea that an ordinary person could borrow money to buy a home, pay it back gradually over decades, and actually end up owning the property? That would seem like magic. It would also seem terrifying. 30 years of debt? The death pledge indeed. But compared to never owning at all, compared to hoping your great-grandchildren might eventually inherit something, compared to working land that could never be yours. Modern mortgages are complicated and often frustrating, but they also represent something genuinely new in human history: the democratization of property ownership, the possibility that ordinary people might own the walls around them. That possibility didn't exist for most of human history. It was created, invented, built up over centuries of gradual change. And the story of how that happened begins in the early modern period, when the old feudal order started to crumble and new ideas about property, lending, and ownership began to emerge. The medieval world was slowly changing. Old certainties were crumbling. New ideas about money, trade, and property were emerging from the most unexpected places. The pieces that would eventually become the modern mortgage were being invented, one by one, century by century, though no one knew yet what they were building. Let's follow the money. In the city-states of Italy, Florence, Venice, Genoa, something remarkable was happening. Banking families were rising to power, not through military conquest or noble birth, but through money itself, through the careful management of other people's wealth. The Medici of Florence are the most famous. Starting as wool traders, they built a banking empire that stretched across Europe. Medici banks operated in Rome, Venice, London, Bruges. They lent to popes and kings. They financed wars and artistic masterpieces. The Bardi and Peruzzi families came before them, growing so wealthy that they could lend to monarchs. When King Edward III of England defaulted on his loans in the 1340s, it helped bring down both families. A reminder that even the mightiest banks could be destroyed by a single royal deadbeat. These Italian bankers developed innovations that still underpin our financial system. Double-entry bookkeeping. Every transaction recorded twice, as a debit and a credit. Assets on one side, liabilities on the other. A system that made it possible to track complex financial relationships, to see at a glance whether a business was thriving or failing. It sounds mundane. It was revolutionary. Letters of credit allowed merchants to travel without carrying gold. Deposit money with a bank in Florence, receive a letter, present it in London, collect the equivalent funds. No need to risk your wealth on dangerous roads. Bills of exchange worked similarly. Promises to pay that could themselves be traded. Early forms of the negotiable instruments that still circulate today. These banking families became more powerful than most royalty. Popes were elected with their support. Wars were won or lost based on who could secure their financing. Monarchs treated them with a mixture of need and resentment. But here's what these great banks were not doing. They weren't lending money to ordinary people to buy houses. Renaissance banks dealt with merchants, with nobles, with governments. They financed trading voyages and military campaigns. They managed the fortunes of the wealthy. A craftsman in Florence who wanted to buy a small house? He wasn't walking into the Medici Bank for a loan. That world didn't exist yet. Property lending for common people remained as distant as ever. The tools were being forged, but they weren't yet being used for this purpose. In the 17th century, the financial center of Europe shifted northward to Amsterdam. The Dutch Republic was something new in the world, a nation of merchants rather than nobles, a society where commerce was respected, where innovation was rewarded, where money mattered more than bloodlines. Amsterdam became the wealthiest city in Europe. Its harbor bristled with ships. Its warehouses overflowed with goods from every corner of the globe. The Dutch East India Company, the VOC, was perhaps the world's first true multinational corporation. It had its own army, its own navy, the power to wage war and sign treaties. And it was funded not by a single wealthy patron, but by shareholders. Ordinary Dutch citizens, well, ordinary wealthy Dutch citizens, could buy shares in the company and participate in its profits. The Amsterdam Stock Exchange, founded in 1602, was the world's first. Shares were traded openly. Prices rose and fell, based on news and speculation. The mechanics of modern financial markets were invented here. The Dutch also pioneered central banking concepts. The Bank of Amsterdam, founded in 1609, provided a stable currency and reliable deposits. Merchants could trust that their money was safe, that transfers would be honored. And here's where things get interesting for our story. Dutch merchants began to see property differently. Land wasn't just something to be inherited or held for generations. It was an investment asset, something that could generate returns, something that could be bought, improved, and sold. Early forms of property-backed securities emerged. Loans secured by real estate, bundled together, sold to investors, the very earliest ancestors of the mortgage-backed securities that would later shake the global economy. The Dutch didn't invent the modern mortgage, but they helped create the conceptual framework. Property as investment, real estate as collateral, financial instruments backed by land, ideas that would travel across the North Sea to England. England, in the late 17th century, was transforming itself. The Bank of England was founded in 1694. Unlike earlier banks that were private family operations, this was something new, a national bank connected to the government, providing stability to the entire financial system. The Bank of England was created, frankly, because the government needed to borrow money. King William III was fighting expensive wars against France. He needed a way to secure long-term financing. The solution was elegant. Private investors would lend money to the government. In return, they received shares in the bank and regular interest payments. The government got its war funds. Investors got a safe, reliable return. This model, government debt held by private investors, managed through a central bank, would become the foundation of modern finance. And as the 18th century progressed, longer-term lending instruments developed, loans that stretched over years rather than months. More sophisticated methods of assessing creditworthiness, a growing infrastructure of legal protections and enforcement. But the truly important innovation for our story came not from the Bank of England or the great merchant banks. It came from working people themselves, building societies. In the late 1700s, a new kind of organization began to appear in English cities. Workers and tradespeople, craftsmen, shopkeepers, skilled laborers, formed mutual aid societies. They called them building societies. The concept was simple, revolutionary but simple. Members would contribute a regular amount each month. These contributions would accumulate in a collective fund, and when enough money had gathered, one member would receive a loan. How did they decide who got the loan? Sometimes by drawing lots, sometimes by auction. Whoever was willing to pay the highest premium got access first, sometimes simply by waiting your turn. The member who received the loan used it to build or buy a house. Then they paid back over time, monthly payments, year after year, while continuing to contribute to the collective fund. Meanwhile, other members kept contributing. The fund kept growing. More loans became available. More members built houses. When everyone had received a loan and repaid it, the society would often dissolve, its purpose complete. These early building societies were terminating. They existed only until all members were housed. This wasn't quite a mortgage in the modern sense. These weren't banks seeking profit. They were cooperative organizations, members helping members. The terms were often more flexible. The relationship was personal. And crucially, you had to be a member. You had to join the society, contribute for months or years before you could receive a loan. It wasn't a service available to just anyone who walked in off the street. But it was closer, much closer than anything that had come before. For the first time, ordinary working people had a path to property ownership that didn't require wealthy relatives or decades of saving every penny. And this innovation arrived at exactly the moment it was needed. The Industrial Revolution was transforming Britain. Factories were rising. Cities were exploding with population. The old rural order, where people lived on farms, often on the same land their families had worked for generations, was collapsing. Workers flooded into cities: Manchester, Birmingham, Liverpool, London. Thousands of people seeking factory jobs, leaving behind the countryside and everything they knew. They needed places to live. Demand for urban housing skyrocketed. Landlords and speculators saw opportunity. Buildings rose quickly, often too quickly, with little concern for safety or sanitation. The urban poor lived in conditions that horrified observers: overcrowded tenements, buildings without adequate ventilation or light, shared toilets, if toilets existed at all. Disease spread easily. Life expectancy in industrial slums was shockingly low. Reformers documented these conditions. Friedrich Engels wrote about Manchester. Charles Dickens wove the horrors of urban poverty into his novels. Society was slowly becoming aware of what industrialization had wrought. Meanwhile, a new social class was emerging: the middle class. Factory managers, skilled professionals, merchants of growing prosperity. People who weren't aristocrats but weren't factory workers either. People with steady incomes and social aspirations. And increasingly, those aspirations included owning a home. Home ownership became a marker of respectability, of stability, of having arrived in the middle class. A rented room was for the poor, a house of one's own. That was what a successful family should have. The desire was there. The need was there. But the financial system to enable it? Still incomplete. Even as building societies spread and banking sophistication grew, true mortgages remained rare. Loans were still short-term by modern standards. 3 years, 5 years, perhaps 10 at the most. The idea of borrowing for 30 years would have seemed absurd. Who knew what might happen in 30 years? Down payments were enormous. If you wanted to borrow money to buy property, you might need 50% up front, sometimes more. The lender wanted assurance that you had substantial resources, skin in the game, we'd call it today. For a middle-class family, saving 50% of a property's value might take a decade or more. You'd be well into middle age before you could even begin the process. Interest rates were high and variable. Rates might be 10%, 12%, even higher. And there was little standardization. Each loan was individually negotiated, with terms that might favor the lender heavily. There was no regulation to speak of, no government agencies setting standards, no consumer protections. If you agreed to predatory terms, that was your problem. And banks, frankly, preferred other kinds of lending. Lending to businesses was safer and more profitable. Lending to governments was practically guaranteed. Why bother with the paperwork and risk of individual property loans when there were better options? The building societies helped, but they were small, local, limited in scope. They couldn't scale to meet the housing needs of an industrializing nation. Something more was needed. And so the class divide persisted. The wealthy could buy property outright. They had capital accumulated over generations. They had connections to private lenders who offered favorable terms. For them, property acquisition was simply a matter of writing a check. The emerging middle class was locked out. They had steady incomes, but not vast savings. They could afford monthly payments, if only someone would offer them. But the loans that would make home ownership possible simply weren't available. Some joined building societies and waited years for their turn. Some saved patiently, hoping to accumulate enough for a massive down payment before they were too old to enjoy a home. Most resigned themselves to renting, and the working class, the factory workers and laborers who powered the industrial economy. For them, home ownership remained a fantasy. Their wages were too low, their employment too insecure. No building society would accept them. No bank would consider their application. They rented, crowded into tenements, moved frequently as circumstances demanded, never putting down roots in a place they could call their own. Property ownership remained what it had always been, a marker of significant wealth, a privilege of the fortunate, a dream for most. The tools existed, scattered across different institutions and innovations: double-entry bookkeeping, central banks, building societies, long-term lending instruments. But no one had assembled them into a system that could offer ordinary people a reasonable path to owning their homes. That would require new ideas, new institutions, new laws. It would require an experiment, a grand experiment in democratizing property ownership. And that experiment would take place not in the old cities of Europe, but in a new nation across the Atlantic, a nation obsessed with land, with ownership, with the idea that every family deserved a plot of earth to call their own. We've seen how property and lending evolved across millennia, from Mesopotamian clay tablets to Roman legal codes to medieval European land transfers that bound families for generations. Now let's cross the Atlantic to a place that promised to be different: America. Here, the story went, land was abundant, opportunity was unlimited. A person could own property through their own labor, not just through inheritance or aristocratic favor. It was a powerful myth. Parts of it were even true. But the reality was more complicated, and for those trying to actually buy property, the financing options were just as brutal as anything in the old world. Let's explore how Americans acquired land and why owning a home remained agonizingly difficult right up until the 20th century. When British colonists arrived in North America, they brought European property concepts with them. Land was granted by the Crown or colonial governments. Large tracts went to wealthy investors, proprietors, and companies. Smaller parcels went to settlers, sometimes free, sometimes for modest fees, always with obligations attached. But there was one crucial difference from Europe. Land seemed endless. In England, every acre had an owner. Families had held the same plots for centuries. A landless person would likely remain landless forever. In America, there was always more land to the west, always another frontier. This created genuine opportunity. Colonists who would never have owned property in Europe could acquire farms in America. Land ownership spread more widely than anywhere in the Old World. But let's be clear about what made this possible. The land wasn't empty. It was inhabited. Indigenous peoples had lived on it for thousands of years, hunting, farming, building communities, developing their own concepts of land use and territory. The colonial project required their displacement through treaties that were broken, through wars of conquest, through policies of removal and extermination. The available land of colonial America was available because its original inhabitants were pushed off, killed, or confined to reservations. This is the foundation upon which American property ownership was built. It's important to name it clearly before we continue. Even with land more accessible, you still needed capital. Clearing forest, building shelter, acquiring tools and livestock, surviving until the first harvest. All of this required resources. The truly poor remained landless, even in America. But the dream was established. In this new world, land ownership was possible, and that dream would shape everything that followed. The dream reached its fullest expression on May 20th, 1862, when President Lincoln signed the Homestead Act. The concept was radical, at least by Old World standards. Any adult citizen or intended citizen could claim 160 acres of public land, pay a small filing fee, live on the land, and improve it for 5 years. And it was yours, free. Work the land, and it becomes your land. The promise of America, written into law. Within a few decades, hundreds of thousands of claims were filed. Families loaded wagons and headed west. Immigrants arrived from Europe specifically for this opportunity. Former slaves, after emancipation, sought homesteads too, though discrimination made their path far harder. The romance of the homesteader became central to American mythology. The self-reliant family, building a life from raw prairie. Independence through hard work. The reality was harsher. The Great Plains were unforgiving. Drought, locusts, brutal winters, isolation that drove people to madness. The nearest neighbor might be miles away. The nearest town, days of travel. Farming 160 acres with 19th century technology was backbreaking. Many homesteaders arrived with little farming experience. Many failed, and the land itself, made available through the forced removal of indigenous peoples. The Great Sioux Reservation was carved up for homesteaders. The Cherokee, already displaced once, lost more territory. Tribe after tribe was pushed onto smaller and smaller reservations to make room for white settlement. About 10% of all U.S. land was eventually distributed through homesteading. It was a massive transfer of property, from indigenous peoples to the federal government to individual settlers, a genuine opportunity for some, built on dispossession for others. Free land sounds like the answer to everything, but it wasn't. The land was free. Everything else cost money. You needed tools, plows, axes, saws. You needed seeds for planting. You needed livestock, at minimum a horse or oxen to work the fields. You needed materials for building shelter. You needed enough food and supplies to survive until your first harvest, which might be a year or more away. Estimates suggest a homesteader needed at least $1,000 in starting capital, equivalent to perhaps $30,000 today. For families without savings, free land remained out of reach. Many who tried failed. About 60% of homestead claims were never completed. Families gave up after a few brutal years. Abandoned claims dotted the prairie, and the best land often didn't go to small farmers at all. Railroad companies received enormous land grants, tens of millions of acres, as incentives to build westward. Speculators filed claims with no intention of farming, then sold to the highest bidder. Large cattle operations grabbed huge territories. By the late 1800s, the frontier was closing. The good land was claimed. The Homestead Act's promise was largely exhausted. For most Americans, especially those in growing cities, owning property still meant buying it, and that required financing. While homesteaders struggled on the prairie, America was urbanizing at remarkable speed. In 1800, about 6% of Americans lived in cities. By 1900, that number approached 40%. New York, Chicago, Philadelphia, these cities exploded with growth fueled by industrialization and waves of immigration. City property was a different world entirely. For workers, the immigrants crowding into factory jobs, the laborers building the new industrial economy, home ownership was nearly impossible. They rented, often in appalling conditions. Tenement buildings packed families into tiny apartments, whole families in single rooms, shared toilets for entire floors, minimal light, minimal ventilation, maximum exploitation. Landlords extracted what they could from people with no alternatives. The emerging middle class aspired to something better, a house of their own, a yard, a piece of the American dream. But urban property was expensive, and the financing options were terrible. Some employers offered company housing, though this often meant another form of control. Some ethnic communities pooled resources through mutual aid societies. Private lenders existed, but their terms reflected the risks they saw and the leverage they held. If you wanted to buy property in 19th century America, you'd better have substantial savings or be prepared to enter an arrangement that could destroy you. The mortgages available in late 19th century America bore little resemblance to what we know today. Here's what you faced. Down payment, typically 50%, half the purchase price, upfront, in cash. Anything less was considered reckless lending. Loan term, 3 to 5 years. Not 30 years, not even 10. A handful of years to make good. Payment structure, interest only. During the loan term, you paid only the interest charges. The principal, the amount you actually borrowed, sat there untouched. And then came the balloon payment. At the end of your term, the entire principal was due, all of it, at once. Let's make this concrete. Say you buy a house for $2,000, a modest sum at the time. You put down $1,000, your 50%. You borrow $1,000. For 5 years, you pay interest, maybe 6 to 8% annually, so $60 to $80 per year. Then year 5 ends, and you owe $1,000, the full amount, immediately. Did you somehow save $1,000 while also paying interest and living your life? Almost certainly not. So what happened? You refinanced. You found another lender willing to take over the loan. They'd pay off the first lender, and you'd start a new term with them, if you could find someone. This was the reality of property ownership in 19th and early 20th century America, the refinancing treadmill. Every 3 to 5 years, you'd need to find a new lender, negotiate new terms, hope conditions were favorable. Each refinancing was a gamble. Interest rates could jump, lenders could demand additional security, terms could worsen. And if you couldn't refinance, foreclosure. You lose the property, you lose your down payment. You lose everything you've put into it. Economic downturns were catastrophic. When the economy contracted, lenders contracted with it. Credit dried up. Even borrowers with perfect payment histories found no one willing to refinance. The Panic of 1873, the Panic of 1893. Each depression brought waves of foreclosures. Families who had made every payment, who had done nothing wrong, lost their homes because the music stopped at the wrong moment. This wasn't ownership in any secure sense. It was a perpetual tightrope walk. One stumble, one recession, one illness, one bad harvest, and you fell. The system worked for lenders who could always seize the property and resell it. It was precarious for everyone else. And yet, people kept trying. Because what was the alternative? After World War I, America roared into prosperity. The economy expanded. The middle class grew. Automobiles, radios, consumer goods, suddenly within reach for ordinary families. And property was booming. New suburbs sprouted around cities. Developers bought farmland and platted streets. Houses went up at unprecedented rates. Florida experienced a land speculation frenzy so intense that people bought and sold lots they'd never seen. The financing hadn't fundamentally changed. Balloon mortgages remained standard. Down payments were still substantial, though some lenders were getting creative, allowing smaller down payments, second mortgages, more leverage. But everyone believed prices would keep rising. Why worry about the balloon payment in 5 years? Your property would be worth more by then. You'd refinance easily, probably for even better terms. Maybe you'd sell at a profit. Speculation infected the market. People bought properties not to live in, but to flip. Prices climbed, not because of underlying value, but because everyone expected them to climb. The same psychology that would drive the stock market to dizzying heights drove property markets too. And just like the stock market, property prices were built on borrowed money and borrowed confidence. The newspapers were full of success stories. The guy who bought a Florida lot for $1,000 and sold it for $10,000 a year later. The families moving into brand new houses in brand new neighborhoods. This was America. Prosperity was permanent. The good times would roll forever. They would not. So here's where we stand as the 1920s reach their peak. America had created more widespread property ownership than Europe ever had. Free land through homesteading, a growing middle class aspiring to homes of their own. But the financing remained brutal. 50% down, short terms, balloon payments, the constant threat of foreclosure if you couldn't refinance. Property ownership wasn't a foundation, it was a tightrope. And in 1929, the rope would snap. What came next? The Great Depression, the wave of foreclosures, the complete collapse of the property market would finally force America to reinvent how people buy homes. From that crisis would emerge something new, the long-term, fixed-rate, fully amortizing mortgage, the 30-year loan, the system we know today. But it would take catastrophe to get there. It would take millions of families losing everything. It would take the federal government stepping in as no one had imagined possible. That transformation is our next chapter. Everything we've discussed so far, the balloon mortgages, the short terms, the massive down payments, the constant vulnerability of homeowners, it all came crashing down at once. The Great Depression didn't just test the American housing system. It shattered it, completely and catastrophically. And from that wreckage, something new would emerge. October 1929. The stock market begins to fall. Black Thursday, Black Monday, Black Tuesday. The market loses nearly half its value in a matter of weeks. Fortunes accumulated over lifetimes evaporate in hours. But the stock crash was just the beginning. Banks began failing. Not one or two, hundreds, then thousands. In an era before federal deposit insurance, a bank failure meant depositors lost everything. Your life savings, kept where you thought it was safe, gone. The line between comfortable and destitute could be crossed in an afternoon. Credit evaporated. Banks that survived stopped lending. Why risk money when the economy was collapsing? Why extend credit when you couldn't be sure of anything? Jobs disappeared. Factories closed. Businesses shuttered. By 1933, 1/4 of the American workforce was unemployed. 25%, 1 in 4. And in the midst of this catastrophe, millions of Americans faced a problem that seemed almost secondary to the larger crisis, but was devastatingly personal. Their mortgages were coming due. Remember how balloon mortgages worked. You paid interest for 3 to 5 years. Then the entire principal came due. You refinanced, got a new mortgage, repeated the cycle. The system depended on one thing: the ability to refinance. In 1930, 1931, 1932, that ability vanished. Banks weren't lending. They couldn't lend. They were struggling to survive, hoarding whatever cash they had. The last thing they wanted was to extend new mortgages in the middle of economic collapse. So when your balloon payment came due, when you needed to refinance that $3,000 you'd borrowed 5 years ago, there was nowhere to go. You couldn't pay. Of course you couldn't pay. Nobody had $3,000 in cash. That was the whole point of the mortgage system. You weren't supposed to pay it all at once. But now you had to. And you couldn't. Foreclosure. The bank took your house. The house you'd been paying on for years. The house where your children had grown up. The house you'd painted and repaired and made into a home. Gone. At the peak of the crisis, estimates suggest over 1,000 foreclosures were happening every single day. 1,000 families daily losing their homes. By 1933, nearly half of all mortgages in America were in default. Half. Millions of families unable to meet their obligations, watching everything slip away. And here's something particularly cruel. Some homeowners weren't even behind on their payments. They'd made every monthly interest payment on time. They'd been perfect borrowers. It didn't matter. When their balloon came due, when they needed to refinance, the bank said no. Not because they were bad risks, but because the bank needed cash, desperately needed cash. Calling in loans was a way to get it. People who had done everything right still lost their homes. The balloon mortgage system was designed for normal times. And these were not normal times. Banks had no incentive to refinance during a crisis. When the economy is collapsing, why would you extend new credit? You'd be throwing good money after bad. Better to foreclose, take the property, wait for things to improve. That each individual bank acting rationally made the overall crisis worse, that foreclosures drove down property values, which weakened bank balance sheets, which caused more foreclosures. Nobody was coordinating. Nobody was thinking systemically. Short-term mortgages meant constant vulnerability. Every few years, every homeowner was exposed to whatever the credit market was doing. In good times, this was fine. In bad times, it was catastrophic. There was no federal insurance, no backstop, no guarantee that anyone would step in if things went wrong. And things had gone very, very wrong. The relatively small down payments of the 1920s, often just 10 or 20%, meant homeowners had little equity cushion. When property values fell, they quickly owed more than their homes were worth. Why keep paying for a house that's underwater? Why struggle to make payments when you'll never recover your investment? Many people simply walked away, handed the keys to the bank, let foreclosure happen. The entire housing market froze. Sellers couldn't sell. Who was buying? Banks accumulated properties they couldn't unload. New construction stopped almost entirely. The system hadn't just failed, it had collapsed in on itself. Behind the statistics were people, families, lives. Imagine working for 20 years to build a life, a job, a home, children in school, a community where you're known and respected. Then the job disappears. Then the bank forecloses. Then you're loading your possessions onto a truck, if you still have a truck, and driving away from everything you built. Where do you go? Some families moved in with relatives, crowded into apartments meant for half as many people. 3 generations under one roof because nobody could afford anything else. Some became migrants, loading families into cars and heading west, looking for work, looking for hope. The Okies of Steinbeck's The Grapes of Wrath, though they came from everywhere, not just Oklahoma, and some ended up in shanty towns, makeshift camps on the edges of cities, shelters built from scrap wood and cardboard and whatever could be scavenged. No plumbing, no electricity, just desperate people with nowhere else to go. They called these camps Hoovervilles, after President Herbert Hoover. It was not a compliment. Homelessness spiked. In a country that had promised opportunity and prosperity, families were living in tents. Children were going hungry. The American dream looked dead, and the public rage was immense. Banks, bankers, the financial system, these became targets of fury. The people who had encouraged borrowing, who had made loans and collected fees, who had lived comfortably while ordinary families struggled, they were blamed, sometimes fairly, sometimes not. But the anger was real. Something had to change. President Hoover tried. To his credit, he recognized the crisis required government action. This was not a time for laissez-faire. But his efforts were too limited, too cautious, too wedded to the idea that private institutions should solve private problems. The Reconstruction Finance Corporation lent money to banks and railroads. It helped some institutions survive. It did little for the families losing their homes. States tried to help. Some imposed foreclosure moratoriums, temporary bans on banks seizing properties. Buy time, hope things improved. The Supreme Court upheld Minnesota's moratorium in 1934, ruling that emergency conditions justified emergency measures. But moratoriums were band-aids on a severed artery. At foreclosure auctions, something remarkable sometimes happened. Neighbors gathered. When the foreclosed farm went up for auction, they intimidated outside bidders away. Then they bid pennies for the property, literal pennies, and handed it back to the original owner. Penny auctions, they called them. A form of community resistance to a system seen as unjust. Sometimes there was violence, farmers with shotguns, sheriffs run off properties, the desperate protecting the desperate. It was clear to anyone watching. The system was broken beyond repair. Tinkering wouldn't fix it. Something fundamental had to change. And in 1932, the country decided to try something different. Franklin Delano Roosevelt won the presidency in a landslide. He promised action, bold action, experimentation. If one approach didn't work, they'd try another. Anything was better than watching the country disintegrate. The New Deal that followed was a whirlwind of legislation. Banks, agriculture, labor, securities, everything was being reformed, regulated, reconstructed, and housing was near the top of the list. Roosevelt understood something important. Home ownership wasn't just an economic issue, it was a political issue, a social issue, a question of what kind of country America wanted to be. A nation of homeowners was stable, rooted, conservative in the best sense, invested in their communities, their property, their future. A nation of renters and the dispossessed was unstable, angry, potentially radical. The specter of revolution, actual revolution, haunted the 1930s in ways we sometimes forget. Saving home ownership wasn't just compassion. It was strategy. In 1933, Congress created something unprecedented, the Homeowners Loan Corporation, HLC. Here's what HOLC did. It bought distressed mortgages from banks, all those loans that were in default that banks were foreclosing on. HOLC purchased them, took them off the bank's books. Then HOLC refinanced those mortgages with the homeowners directly, but on completely different terms. 15 years, not 3 years, not 5 years, 15 years to repay. Lower interest rates, affordable monthly payments, and crucially, amortization. Amortization meant that every payment reduced the principal. You weren't just paying interest while the full amount hung over your head. Each month, you owed a little less. Each month, you made progress. At the end of 15 years, you owned your home free and clear. No balloon payment. No need to refinance, just done. HOLC saved approximately 1 million homeowners from foreclosure. 1 million families who would have lost everything, instead, kept their homes. It was a bailout. Let's be honest about that. The federal government stepped in to rescue homeowners and banks alike from a crisis they'd collectively created. But it worked. The significance of HOLC extends far beyond the immediate crisis. This was the first time the federal government had intervened in housing on this scale. The first time Washington had declared, in effect, that homeownership was a public good worth protecting. Before HOLC, housing was private. Your mortgage was between you and your bank. The government had no role. After HOLC, the government was permanently involved, setting terms, providing guarantees, shaping the market. This was a radical shift in American political economy. The government had asserted that some things were too important to leave entirely to private markets. That intervention was sometimes necessary, that the public had an interest in private housing. Some celebrated this as progress. Others warned of creeping socialism. The debate continues to this day, but practically speaking, HOLC proved something crucial. Longer-term, amortizing mortgages worked. Homeowners could handle 15-year terms. Monthly payments could be structured affordably. The balloon mortgage didn't have to be the only model. There were alternatives, better alternatives. The stage was set for the modern mortgage. But we cannot tell this story honestly without acknowledging something else. HOLC, in the process of refinancing mortgages across the country, created detailed maps of American neighborhoods. Every city was surveyed, every neighborhood assessed. The assessments rated neighborhoods by perceived risk: green for the best, blue for still desirable, yellow for declining, red for hazardous. The red areas, the hazardous neighborhoods, were almost always black neighborhoods, or neighborhoods with immigrants, or neighborhoods with Jewish residents. This practice became known as redlining, literally drawing red lines around communities deemed unworthy of investment. If your neighborhood was redlined, you couldn't get a HOLC loan. You couldn't benefit from the government's rescue. You were excluded. And these maps would be used for decades. Private banks adopted them. The FHA, which we'll discuss shortly, used them. Redlining shaped where investment flowed and where it didn't. White neighborhoods received loans, investment, infrastructure, property values rose, wealth accumulated. Black neighborhoods were starved of capital. Properties deteriorated, wealth stagnated or declined. The great expansion of American home ownership that would follow, the democratization of property ownership that we celebrate, was largely for white Americans only. Black families were systematically excluded, not by accident, by design, written into the maps, embedded in the policies. This discrimination would shape American cities for generations. The racial wealth gap we see today traces directly back to these decisions. Neighborhoods that were redlined in the 1930s still show the effects. The New Deal saved American home ownership. It also embedded American racism into the physical and financial structure of the nation. Both things are true. Both must be remembered. The government had learned how to make home ownership work. Now, it would scale that system nationwide, building the 30-year mortgage that would define American life for the next century. The Great Depression had just shattered everything. Banks collapsed. Foreclosures swept across America like a plague. 1,000 families a day losing their homes at the crisis's peak. The property financing system, those brutal balloon mortgages, that constant refinancing treadmill, had revealed its fatal flaw. When credit disappeared, so did home ownership. By 1933, the housing market lay in ruins. Construction had nearly stopped. Unemployment in the building trades exceeded 30%. The dream of owning a home seemed further away than ever. But from this catastrophe, something remarkable would emerge. A system so revolutionary it would transform not just housing, but the entire American economy and culture. The modern mortgage was about to be born. In 1934, as part of the National Housing Act, President Franklin Roosevelt created the Federal Housing Administration, the FHA. The mission was ambitious: make home ownership accessible to ordinary Americans. But the FHA didn't work the way you might expect. It didn't lend money directly. It didn't buy houses for people. Instead, it did something cleverer. It insured mortgages. Here's how it worked. A private bank makes a mortgage loan. The FHA reviews the loan, and if it meets their standards, insures it. If the borrower defaults, the FHA pays the bank. This might sound like a small, technical detail. It wasn't. It changed everything. Remember why banks offered those terrible balloon mortgages? Because lending for property was risky. Borrowers might default. Property values might fall. Banks protected themselves with huge down payments, short terms, and the constant ability to refuse refinancing. FHA insurance removed that risk. If the borrower defaulted, the government covered the loss. Suddenly, banks could afford to be generous. Not out of kindness, out of simple math. With the government guaranteeing the loan, banks could offer terms that would have seemed insane just a few years earlier. The revolution was about to begin. Before the FHA, you needed 50% down. After the FHA, you needed 20%. Eventually, 10%. Later, even less. Before the FHA, you got a 5-year term, maybe 7. After the FHA, you got 30 years. Before the FHA, You made interest-only payments, then faced a balloon. After the FHA, your loan was fully amortized. That word, amortized, is crucial. Let me explain what it means. With a fully amortized loan, every monthly payment covers both interest and a portion of the principal. With each payment, you owe a little less. After 30 years of payments, you owe nothing. The house is yours. No balloon payment, no refinancing required, no treadmill. And the interest rate was fixed. Whatever rate you agreed to at the beginning stayed the same for 30 years. Your payment in year 1 was the same as your payment in year 29. You could plan, you could budget, you knew exactly what you owed for exactly how long. This had never existed before, not in America, not anywhere. The 30-year fixed-rate, fully amortizing mortgage was a genuine invention, as transformative in its way as the cotton gin or the assembly line. For the first time in human history, ordinary people could buy homes with manageable payments spread over decades. The door to home ownership swung open. Let's pause to appreciate how radical this was. For millennia, property ownership required either inheritance or substantial capital. The exceptions were rare: homesteading, unusual circumstances. Generally, if you weren't born with land, you wouldn't die with it either. The 30-year mortgage changed that equation entirely. Suddenly, you didn't need a fortune. You needed a steady job and a modest down payment. You could start a family, buy a house, and pay it off over your working life. The monthly payment on a 30-year mortgage was dramatically lower than on a 5-year loan. A house that was completely unaffordable with a balloon mortgage became manageable with amortization. And you didn't face the refinancing cliff. No more hoping credit markets would cooperate. No more losing everything because you hit a recession at the wrong moment. The risk shifted. Before, borrowers bore almost all of it. Now, the risk was distributed, shared between borrower, lender, and government. This was a fundamental restructuring of how property transfer worked, as significant in its own way as the shift from feudal tenure to fee simple ownership centuries earlier. The American middle class was about to be built on this foundation. The effects rippled outward immediately. Home ownership rates began climbing. People who had never imagined owning property suddenly could. The construction industry, devastated by the Depression, roared back to life. Builders could sell houses because buyers could get mortgages. Lumber mills, appliance manufacturers, furniture makers, entire supply chains revived. Suburbs began spreading from city edges. The automobile had made commuting possible. The mortgage made suburban homes purchasable. Together, they would reshape the American landscape. And home ownership became identity. Owning your home meant you had arrived. You were stable, responsible, American. The house with the yard and the picket fence became the symbol of middle-class success. This wasn't just economics anymore. It was culture. It was aspiration. It was what you were supposed to want. The mortgage had created not just a financing mechanism, but a way of life. In 1938, the system gained another crucial piece: the Federal National Mortgage Association. Fannie Mae. Here was the problem. Banks had limited capital. Even with FHA insurance, they could only make so many loans before running out of money to lend. Fannie Mae solved this by creating a secondary market. Here's how it worked. A bank makes a mortgage. Fannie Mae buys that mortgage from the bank, paying cash. The bank now has fresh capital to make another loan, and another, and another. Fannie Mae holds the mortgages, collecting the monthly payments, or it bundles them and sells them to investors. Either way, money keeps flowing into the system. This liquidity transformed mortgage lending. Banks were no longer limited by their deposits. The secondary market created an almost unlimited source of mortgage capital. Fannie Mae also enforced standardization. To sell a mortgage to Fannie Mae, it had to meet specific criteria. This meant mortgages looked the same across the country. Terms were consistent. Paperwork was uniform. Standardization made the market more efficient. More efficient meant more loans. More loans meant more homeowners. The pieces were coming together. Then came World War II, and after it, the deluge. The GI Bill, passed in 1944, offered returning veterans something unprecedented: zero-down mortgages guaranteed by the VA. Not 20% down, not 10%, nothing. 16 million Americans had served in the war. Now they came home, started families, and needed places to live. The housing industry had never seen anything like it. Developers like Levitt and Sons pioneered mass-produced housing. Levittown on Long Island became the model. Thousands of nearly identical houses, built quickly and cheaply, sold to young families with VA and FHA mortgages. Between 1940 and 1960, the American home ownership rate jumped from 44% to 62%, nearly 20 percentage points in 2 decades. Suburbs exploded outward from every city. New highways connected them. New schools served them. New shopping centers supplied them. Home ownership wasn't aspirational anymore. It was expected, normal. The thing you did when you got married and had children. An entire generation built their lives around the 30-year mortgage. But we cannot tell this story honestly without confronting what it left out. And who? The FHA didn't just insure mortgages. It decided which mortgages to insure. And those decisions were explicitly, deliberately, systematically racist. The FHA's underwriting manual warned against inharmonious racial groups. It instructed appraisers to lower ratings for neighborhoods with black residents. It recommended deed restrictions prohibiting sale to black buyers. This was redlining, the practice of drawing red lines on maps around black neighborhoods and refusing to insure mortgages there. Without FHA insurance, banks wouldn't lend in these areas. Without loans, property values stagnated. Without rising values, wealth couldn't accumulate. The suburbs blooming across America were almost entirely white. The VA loans that sent millions of veterans into home ownership, black veterans were systematically denied, steered to segregated areas, excluded from the wealth-building machine. Levittown's original deeds explicitly prohibited black ownership. This wasn't a few bad actors. It was official policy, written into contracts, enforced by courts. The result was a wealth gap that persists to this day. White families bought homes in the 1950s that appreciated for decades. They built equity. They passed wealth to their children. Those children used that wealth for education, for businesses, for their own down payments. Black families excluded from this system couldn't build the same foundation. The median white family today has roughly 10 times the wealth of the median black family. This gap traces directly to housing policy, to mortgages insured and mortgages denied, to suburbs opened and suburbs closed. The 30-year mortgage was revolutionary, but its benefits were not distributed equally, and the inequality it created, by design, not by accident, remains one of America's defining injustices. Step back and see the full system. Government backing through FHA insurance removed lender risk. Standardization through FHA requirements and Fannie Mae purchases created uniform products. The secondary market provided endless liquidity. Post-war economic growth supplied jobs and rising incomes. Cultural transformation made homeownership central to American identity. All of these pieces interlocked. Remove any one, and the system might not have worked. It was a genuinely new thing in human history. Mass homeownership, financed over decades, supported by government, embedded in culture. Other countries developed their own approaches. Many never adopted the 30-year fixed rate. Variable rates are more common in Britain, Canada, Australia. Terms vary widely. But the American model became the American standard, and it reshaped what Americans expected from life. The modern mortgage was born from catastrophe. The Depression's devastation forced innovation. The FHA's insurance transformed what banks would offer. The 30-year fixed-rate loan made homeownership achievable for millions. It was a genuine revolution in housing, in wealth building, in the shape of American cities and the texture of American life. But it was also a revolution with boundaries, drawn deliberately, enforced systematically. Those boundaries created opportunities for some and walls for others. The system worked brilliantly for those it included. For those it excluded, it was another chapter in a long history of dispossession. For decades, the mortgage system hummed along. Home ownership rates rose, suburbs sprawled. The American dream seemed secure, but systems designed for stability can become systems of speculation. The very mechanisms that made mortgages safe could be twisted into something dangerous. In our next segment, we'll watch the mortgage market transform again, this time into something its creators never intended: securitization, subprime lending, and eventually, catastrophe. The 2008 crisis was still decades away, but its seeds were already planted. The system we've described, FHA loans, 30-year fixed mortgages, Fannie Mae, stable and predictable home ownership, worked remarkably well for decades. Too well, perhaps. People started to forget why the rules existed, started to think they were unnecessary constraints rather than hard-won protections. And slowly, piece by piece, the system was transformed into something its creators wouldn't have recognized. Let's watch it happen. The trouble began with inflation. In the 1970s, prices started rising. Oil shocks, government spending, monetary policy, the causes were complex and debated, but the effect was clear. The dollar bought less every year. The Federal Reserve responded by raising interest rates. Higher rates meant less borrowing, less spending, less inflation. That was the theory. By the early 1980s, interest rates had reached levels that seem almost fictional today. Mortgage rates topped 17%, 18%. For a brief moment, they touched 20%. Imagine paying 20% interest on a 30-year mortgage. Your monthly payment would be crushing. The total interest paid over the life of the loan would be staggering. But here's the thing. Those high rates were a problem, not just for borrowers, but for lenders too. Savings and loans, the institutions that had become the backbone of American mortgage lending, were in trouble. They'd made millions of 30-year fixed-rate mortgages at 5%, 6%, 7% in previous decades. Now, they were paying depositors 10%, 12%, just to keep savings accounts competitive, paying out more than they were receiving, bleeding money. The mismatch was unsustainable. The industry's solution was the adjustable rate mortgage, the ARM. With an ARM, the interest rate wasn't fixed for 30 years. It adjusted. Every year or every few years, the rate would change based on broader interest rate movements. This shifted risk. Lenders were no longer locked into low rates while inflation raged. If rates rose, the borrower's payments rose too. For borrowers, ARMs offered lower initial rates. Attractive, especially when fixed rates were astronomical, but unpredictable. Your payment this year might be affordable. Next year, who knew? The certainty of the fixed-rate mortgage, the knowledge that your payment would never change, was being traded for short-term savings. In 1970, Congress created another institution, the Federal Home Loan Mortgage Corporation, Freddie Mac. Freddie Mac did essentially what Fannie Mae did, bought mortgages from lenders, creating liquidity in the market. Now there were two giant government-sponsored enterprises buying mortgages. Competition increased. More money flowed into housing. More Americans could get loans. The secondary market, where mortgages were bought and sold after origination, grew enormous. Trillions of dollars in mortgages, bundled and traded, flowing through financial markets. This seemed like progress, more efficiency, more home ownership, more American dream. What it also meant was distance, growing distance between the person who made the loan and the person who ultimately owned it. Your local bank might originate your mortgage, but within weeks, that mortgage would be sold to Fannie or Freddie. Your bank got their money back. They moved on to the next loan. If you couldn't pay, if you got into trouble, your bank no longer cared. They didn't own your loan anymore. The relationship between borrower and lender, once personal and ongoing, became transactional and brief. The 1980s brought a new philosophy to Washington. Government was the problem, not the solution. Regulations stifled innovation. The market should be free. Banking regulations were loosened. Savings and loans, once restricted to simple mortgage lending, could now invest in riskier ventures. Commercial real estate, junk bonds, whatever promised higher returns. The types of mortgages available multiplied. Interest-only loans, where you paid no principal at all, just interest, for years. Balloon payments, yes, they came back. Option ARMs, where you could choose how much to pay each month. Mortgage brokers proliferated. These weren't banks themselves. They were intermediaries who connected borrowers with lenders, earning fees for each transaction. Brokers had an incentive to close deals. The more mortgages they arranged, the more they earned. Whether those mortgages were appropriate for the borrowers, whether the borrowers could actually afford them long-term. Less important than getting signatures on documents. Creative financing became a buzzword. Finding ways to make deals work. Making homeownership accessible to people who couldn't qualify for traditional mortgages. Some of this was genuinely helpful. More options meant more people could find terms that worked for their situations. But more options also meant more risk. More ways for people to get in over their heads. More opportunities for the unscrupulous to take advantage. The guardrails were coming down. The consequences arrived in the late 1980s and early 1990s. Savings and loans had been given freedom to invest beyond mortgages. Many invested badly. Commercial real estate collapsed. Risky bets went wrong. S&Ls started failing. Not a few. Hundreds. The Federal Savings and Loan Insurance Corporation, which insured deposits at S&Ls, ran out of money. It couldn't cover all the failures. Taxpayers stepped in. The eventual cost of the S&L bailout exceeded $130 billion in 1990s dollars. An enormous sum. Thousands of employees lost jobs. Many depositors, despite insurance, lost savings. Executives at failed institutions walked away wealthy, while ordinary people suffered. There were investigations, prosecutions, hand-wringing about what had gone wrong. And supposedly, lessons were learned. Supposedly, regulators would be more careful. Supposedly, the system was being fixed. Spoiler, the lessons didn't stick. The 1990s and early 2000s brought something new: falling interest rates. After the high rates of the 1980s, rates declined, steadily, significantly. A mortgage that cost 15% in 1982 might cost 7% in 1998, 6% in 2002, even lower later. Homeowners realized they could refinance, replace their old, high-rate mortgage with a new, lower-rate one. Monthly payments would drop, savings would add up. Refinancing became a national pastime. Banks marketed aggressively. Lower your payment. Save hundreds a month. Homeowners lined up. And while refinancing, why not take some cash out? Home equity lines of credit, HELOCs, became popular. Your home had increased in value. That increase was equity, wealth you could borrow against. Want a new kitchen? Borrow against your home. Kids' college tuition? Borrow against your home. Credit card debt piling up? Consolidate it by borrowing against your home. Your home is an ATM. That phrase actually entered the culture. Your house wasn't just shelter, it was a source of ready cash. As long as home prices kept rising, this seemed to work. Your equity increased. You borrowed some. Prices rose more. You still had equity. But if prices ever stopped rising, nobody wanted to think about that. Behind the scenes, something more fundamental was changing. Mortgages were being bundled together into securities. Hundreds, thousands of mortgages combined into a single financial product. Mortgage-backed securities, MBS. These securities were sold to investors around the world. Pension funds, insurance companies, foreign governments, anyone seeking steady returns. The theory was sound. Bundling mortgages spread risk. If one homeowner defaulted, it barely mattered. The loss was absorbed across thousands of mortgages. The overall security remained safe. And this created enormous appetite for more mortgages. Investors wanted these securities. They seemed safe and profitable. To create more securities, you needed more mortgages. To make more mortgages, lenders had to find more borrowers. But here's where things went wrong. Lenders became careless. Why be careful about who you lent to? You weren't going to hold the mortgage. You'd sell it immediately, bundle it into a security, pass the risk to someone else. The mortgage broker earned a fee for closing the deal. The bank earned a fee for originating the loan. The investment bank earned a fee for bundling the security. Everyone made money up front. If the borrower couldn't actually afford the loan, if they defaulted in 2 years, that was someone else's problem. The fees were already collected. Rating agencies, the companies that assess the safety of financial products, slapped AAA ratings on these securities, the highest possible rating, as safe as government bonds. They weren't. The connection between lender and borrower, already frayed, was now completely broken. Nobody was responsible for the long-term success of these loans. Everyone was just passing paper and collecting fees. With demand for mortgages insatiable, lenders went looking for new borrowers. They found them in the subprime market. Subprime borrowers were people with poor credit histories, lower incomes, less stable employment, people who wouldn't qualify for traditional mortgages. In the past, these people had been declined, told they couldn't afford home ownership. protected in a sense from taking on debt they couldn't handle. Now they were welcomed, pursued, aggressively marketed too. Subprime mortgages came with higher interest rates. Lenders claimed this compensated for the higher risk, but the rates weren't just higher, they were structured to explode. A typical subprime loan might start with a low teaser rate, 2%, 3%, affordable payments for the first 2 years. Then the rate reset, adjusted upward. Suddenly, payments doubled, tripled, became completely unaffordable. The theory was that borrowers would refinance before the reset. Home prices would rise. They'd have equity. They'd qualify for a better loan. And if home prices didn't rise, if they couldn't refinance, nobody wanted to think about that either. Then there were the liar loans, stated income mortgages. The borrower said what they earned. Nobody verified it. The incentive to exaggerate was overwhelming. Ninja loans, no income, no job, no assets. Loans given to people with nothing, literally nothing. Just a signature and an optimistic home price projection. This sounds like fraud. Much of it was fraud. But it was happening at industrial scale, with the participation of major financial institutions, blessed by regulators who either didn't understand or didn't care. Home prices rose and kept rising. Markets that had been affordable became expensive, then very expensive, then completely untethered from any reasonable valuation. Houses that sold for $200,000 in 2000 sold for $400,000 in 2005, $600,000 in 2007. Speculation became rampant. People bought houses not to live in, but to flip. Buy in January, sell in June, pocket $50,000. Do it again. Investment properties purchased with no money down. Rental income would cover the mortgage, they assumed, and when prices rose, they'd sell for a profit. Television shows celebrated flipping. Getting rich through real estate became a cultural phenomenon. Everyone knew someone who'd made a fortune. House poor entered the lexicon. Families spending 50, 60, 70% of income on housing. Mortgages so large that nothing was left for anything else. But it would be fine. Prices would keep rising. Equity would accumulate. Everything would work out. Some people warned. Economists, analysts, the occasional journalist. They looked at the numbers and saw something unsustainable. A bubble, inflating to dangerous proportions. They were ignored, dismissed as pessimists, party poopers who didn't understand the new economy. Real estate only goes up. Everyone knew that. It was different this time. It's never different. The innovations of the New Deal, careful lending, long-term stability, government oversight, had been corrupted beyond recognition. The system that had democratized home ownership was now a casino. Everyone was gambling. Everyone was winning. Until they weren't. The crash, when it came, would be catastrophic. And it was coming very, very soon. Everything we've described, the securitization, the subprime lending, the exotic mortgages, the rating agency failures, all of it was building towards something. A reckoning. In 2006, the American housing market was the largest asset class in the world. Trillions of dollars in value. The foundation of household wealth. The engine of the economy. And it was built on a lie. The lie that housing prices would always rise. When that lie was exposed, the consequences would ripple across the globe, destroying lives, toppling institutions, and triggering the worst economic crisis since the Great Depression. This is what happened when the bubble popped. It started slowly, almost imperceptibly. In mid-2006, Home prices stopped rising in some markets. Not crashing, just flattening. After years of 10, 15, 20% annual appreciation, the engine sputtered. At first, few worried. Prices had paused before. They'd resumed climbing. They always had. But this time was different. The entire edifice was built on appreciation. Without rising prices, everything broke. Remember those adjustable rate mortgages? Those 228 loans with low teaser rates for 2 years? In 2006 and 2007, millions of them began resetting. A family paying $1,200 a month suddenly owed $1,800 or $2,200 or more. The payment shock was devastating. Some borrowers had been told to refinance before the reset, but refinancing required equity, and if prices weren't rising, if they were actually falling, there was no equity. You were trapped. Defaults began to spike. Borrowers simply couldn't make the new payments. Some tried to sell, but in a falling market, that meant selling at a loss. Many couldn't even sell for what they owed. Foreclosure notices started arriving. First a trickle, then a stream, then a flood. By late 2007, the trickle had become a torrent, and the supposedly safe mortgage-backed securities that Wall Street had built, they were stuffed with these failing loans. The bomb was starting to detonate. Here's where the architecture of securitization turned toxic. Those mortgage-backed securities, the CDOs, the tranches rated AAA, they weren't held by one bank. They were everywhere. Pension funds, insurance companies, investment banks, foreign governments, scattered across the global financial system. As mortgages defaulted, these securities lost value, sometimes a little, sometimes catastrophically. Those AAA tranches that were supposed to be safe, many weren't. Banks started reporting losses, billions of dollars, then tens of billions. The more they looked at their books, the worse it got. And here's what froze the system. Nobody knew who held what. The securities were so complex, so layered, so sliced and diced, that even the banks themselves couldn't determine their exposure. If Bank A didn't know what Bank B was holding, why would Bank A lend to Bank B overnight? What if Bank B collapsed tomorrow? Interbank lending, the lubricant of the entire financial system, seized up. In March 2008, Bear Stearns collapsed. One of the oldest, most prestigious investment banks on Wall Street, gone in days. The Federal Reserve engineered an emergency sale to JP Morgan to prevent total chaos. For a moment, people thought the crisis might be contained. It wasn't. On September 15, 2008, Lehman Brothers filed for bankruptcy. This time, there was no rescue. The government let it fail. The result was panic. Pure, primal, financial panic. Stock markets cratered. Credit markets froze completely. Banks wouldn't lend to anyone. Not to each other, not to businesses, not to consumers. The global financial system, interconnected and interdependent, teetered on the edge of complete collapse. While Wall Street trembled, Main Street was drowning. The foreclosure wave that had started as a ripple became a tsunami. In 2008 alone, over 3 million foreclosure filings. In 2009, even more. And 2010. And 2011. Entire neighborhoods were devastated. Drive through certain parts of Las Vegas, Phoenix, Miami, and you'd see block after block of empty houses, lawns dead, windows dark, for sale signs weathered and faded, vandals and squatters moving in. Property values collapsed. In some markets, prices fell 50% or more. The house you bought for $300,000 was now worth $150,000, but you still owed $280,000 on your mortgage. This was being underwater, owing more than your home was worth. By 2011, nearly a quarter of all American mortgages were underwater, tens of millions of families trapped. Some kept paying, hoping for recovery. Others couldn't. Job losses, medical emergencies, the simple math of unaffordable payments. And some made a calculated decision: strategic default. Why keep paying $2,000 a month for a house worth less than you owed? Walk away, let the bank have it, destroy your credit, but stop the bleeding. The human cost was staggering. Families who had done everything right, worked hard, saved for down payments, made their payments on time, watched their wealth evaporate. Their kids changed schools, their marriages strained, their retirements vanished. The American dream, built on homeownership, had become a nightmare. By October 2008, the government faced a terrifying choice: let the financial system collapse entirely or intervene on a scale never before imagined. They chose intervention. The Troubled Asset Relief Program, TARP, authorized $700 billion to stabilize the financial system. The Treasury would inject capital directly into banks, buying preferred stock to keep them solvent. Fannie Mae and Freddie Mac, those pillars of the mortgage system, were placed into government conservatorship. They had guaranteed trillions in mortgages. Their failure would have been cataclysmic. AIG, the insurance giant that had written billions in credit default swaps on mortgage securities, received an $85 billion bailout. Then more. Eventually, over $180 billion, too big to fail, entered the vocabulary. Banks so large, so interconnected, that their collapse would bring down everything else. They would be rescued regardless of their mistakes. The public fury was intense. Wall Street had created this catastrophe through greed and recklessness. Now, taxpayers were rescuing them. Bankers who had earned millions in bonuses during the boom would keep their jobs, their houses, their wealth. Meanwhile, ordinary Americans lost everything. The anger was justified, and it would reshape American politics for years to come. The bailouts prevented total collapse, but they couldn't prevent the Great Recession. Unemployment hit 10% officially. The real number, including those who had stopped looking, those working part-time who needed full-time, was far higher. 8 million jobs disappeared. Trillions in household wealth evaporated. Retirement accounts were decimated. College funds depleted. The recovery was agonizingly slow, not like past recessions, where sharp downturns were followed by sharp rebounds. This one dragged on for years. Some sectors never fully recovered. Some regions, the Rust Belt, certain rural areas, still haven't, and the psychological scars ran deep. A generation of young adults entered the workforce during the worst job market in decades. Millennials delayed home purchases, marriage, children. The economic trajectory of their lives was permanently altered. Older workers, laid off in their 50s, never found equivalent jobs. They retired early with less. Some never recovered financially. The 2008 crisis wasn't just a financial event, it was a trauma, a collective wound that shaped how Americans thought about institutions, about the economy, about whether the system was fair. For many, the answer was clearly no. What did we learn? And did anything change? The lessons seemed obvious. Financial deregulation had gone too far. Predatory lending was destructive. Housing bubbles were real and dangerous. Securitization without oversight was reckless. The interconnectedness of the financial system was a vulnerability, not just a feature. In 2010, Congress passed the Dodd-Frank Wall Street Reform and Consumer Protection Act. The law created the Consumer Financial Protection Bureau, a new agency specifically tasked with protecting borrowers from predatory practices. The CFPB could write rules, examine lenders, and enforce consumer protection laws. Dodd-Frank imposed stricter requirements on banks, more capital reserves, stress tests to see if they could survive another crisis, limits on certain risky activities. Mortgage lending tightened dramatically. No more stated income loans, no more no-documentation loans. Lenders had to verify income, employment, and ability to repay. The qualified mortgage standard emerged, loans that met specific criteria for borrower protection. Lenders who made qualified mortgages received legal safe harbor from lawsuits. Did it work? Partially. The reforms made the mortgage market safer. Another 2008-style crisis seems less likely. But critics argued Dodd-Frank didn't go far enough. No major banker went to prison. Too big to fail banks got even bigger. And the reforms didn't help those who had already lost everything. Today, the 30-year fixed-rate mortgage remains the American standard. But the system looks different than it did before the crash. Underwriting is strict. Lenders verify income carefully. They check employment. They scrutinize bank statements. Debt-to-income ratios matter. Credit scores matter enormously. Down payments have crept back up. While FHA still offers low down payments, 3.5% for qualified buyers, conventional loans often require more, especially for the best rates. The era of easy money is over. Buying a home now requires documentation, patience, and financial preparation. FHA and VA loans remain crucial pathways for lower-income and first-time buyers. But the process is more rigorous than pre-crash. Housing affordability has become a major challenge, though for different reasons than 2006. It's not that loans are too easy. It's that prices, in many markets, have risen far faster than incomes. The median home price has reached levels that put ownership out of reach for many Americans, even with good credit and steady employment. The mortgage crisis of 2008 was solved. The housing affordability crisis of the 2020s is just beginning. And through all of this, the racial inequities in American housing not only persisted, they worsened. The 2008 crisis hit Black and Latino communities hardest. Remember those subprime loans, those predatory products with exploding rates? They were disproportionately marketed to communities of color. Even Black borrowers with good credit were steered towards subprime products more often than white borrowers with similar profiles. Wells Fargo loan officers called them ghetto loans. They targeted Black churches, Black neighborhoods, Black families, pushing products designed to fail. When the crash came, these communities were devastated. Foreclosure rates in Black neighborhoods far exceeded those in white areas. Wealth that had taken generations to build, what little had been allowed to accumulate, was wiped out. The homeownership gap between white and Black Americans, which had been slowly narrowing, widened again. Today, white homeownership exceeds 70%. Black homeownership sits below 45%, lower than in 2000. The FHA's redlining legacy echoes still. Neighborhoods that were redlined in the 1930s remain lower value today. The geographic sorting of American wealth created by design perpetuates itself. Reforms have been made. Discrimination is illegal. but outcomes remain unequal. The American mortgage system created wealth for millions, but not equally, never equally. And the crisis of 2008 was, in many ways, the latest chapter in that longer story. So here's where we stand. The 2008 financial crisis was the worst economic disaster since the Great Depression. It destroyed millions of lives, toppled titans of Wall Street, reshaped the global economy. It was born from the same system that had built middle-class prosperity: the 30-year mortgage, securitization, government backing. The tools that made home ownership possible were twisted into instruments of extraction and destruction. The reforms that followed made the system safer. The reckless lending of the bubble years seems unlikely to return. The mortgage market today is more cautious, more regulated, more skeptical. But housing remains unaffordable for many. The wealth gap persists. The dream of ownership recedes for a new generation. The 30-year mortgage, born from the Depression, refined through decades of policy, wounded in the crisis, it survives. It remains the pathway to home ownership for most Americans. But what does that pathway look like today? Who can walk it and who cannot? What does the future hold for a system that has given so much and taken so much away? In our final segment, we'll bring this journey full circle, from Mesopotamian land transfers to modern mortgage apps, from clay tablets to credit scores. And we'll ask what all of this history teaches us about the most fundamental question: what does it really mean to own a home? The system that emerged from the 2008 crisis, reformed, regulated, supposedly safer, is the one we live with today. But that doesn't mean it's simple, or affordable, or working well for everyone. Let's look at where mortgages stand now, and then zoom out to see how the rest of the world handles home ownership. Because the American way isn't the only way. It's not even necessarily the best way. The 30-year fixed-rate mortgage remains the American standard. The product that emerged from the New Deal, refined over decades, survived the crisis. Most Americans who buy homes use some version of it. 15-year mortgages have grown popular too. Higher monthly payments, but less interest paid over the life of the loan. You build equity faster. You're free of debt sooner. Interest rates fluctuate, sometimes dramatically. In 2020 and 2021, rates dropped to historic lows, below 3%. In some cases, below 2.5%. Homeowners rushed to refinance. Buyers rushed to purchase. By 2023 and 2024, rates had climbed significantly higher: 6%, 7%, even approaching 8% for some borrowers. The difference is staggering. A $300,000 mortgage at 3% costs roughly $1,260 per month. At 7%, that same mortgage costs nearly $2,000 per month. Same house, same price. Completely different affordability. The average down payment today is around 12%, far less than the 20% traditionally recommended. FHA loans require as little as 3.5%. Some programs require nothing at all. But then come closing costs: origination fees, appraisal fees, title insurance, recording fees, attorney fees in some states, thousands of dollars added to the transaction. Your monthly payment typically includes more than just principal and interest. Property taxes, homeowners insurance, sometimes mortgage insurance if your down payment was small. The acronym is PITI: principal, interest, taxes, insurance. For most American families, this monthly mortgage payment is their single largest expense. Larger than food, larger than transportation, larger than everything else combined. The mortgage defines financial life for decades. But can you even get a mortgage in the first place? Housing prices have risen far faster than wages. This isn't a recent phenomenon. It's been happening for decades, accelerating in recent years. In many American cities, home ownership has become functionally impossible for average workers. San Francisco, New York, Los Angeles, Boston, Seattle, even cities that were affordable a decade ago have seen prices explode. The traditional advice, save for a down payment, buy a starter home, build equity, trade up, assumes starter homes exist. Increasingly, they don't. The small, modest houses that previous generations used as first steps have been torn down, converted to rentals, or priced beyond reach. What remains costs what a substantial family home cost 20 years ago. The rent versus buy calculation, once clearly favoring buying, has shifted. In many markets, renting is actually cheaper month to month. The wealth-building advantages of ownership can't materialize if you can't afford to own. Multi-generational households are increasing. Adult children living with parents longer. Multiple families sharing homes. Arrangements that were common a century ago became rare and are now returning out of necessity. Surveys of millennials and Gen Z reveal deep pessimism. Many doubt they'll ever own homes. The American dream that defined their parents' and grandparents' generations feels like a cruel joke. The mortgage system exists. The question is whether anyone can afford to use it. Of course, America is vast. What's true in San Francisco isn't true in Des Moines. Coastal cities, particularly on the east and west coasts, have astronomical prices. Competition is fierce. Bidding wars, common. Cash buyers, often investors, crowd out ordinary families. The Midwest and South remain more affordable. Houses that cost $1 million in California might cost $200,000 in Ohio or Texas. Working families can still realistically buy homes, but wage disparities matter. That cheaper house comes with a lower-paying job. The ratio of home price to income may not be as different as raw numbers suggest. Rural areas offer cheap housing, very cheap sometimes, but jobs are scarce, services are distant, the trade-offs are significant. Move to where you can afford is advice often given. It ignores economic realities. Your job is where it is. Your family is where they are. Your career, your network, your children's schools, these aren't easily transplanted. Some people do move. Remote work has enabled geographic flexibility for some professions. But for most workers, service workers, healthcare workers, teachers, tradespeople, the job determines the location. Affordability varies, but for many, the affordable places are places they cannot realistically go. The conventional 30-year fixed isn't the only option. Various programs exist to help different borrowers. FHA loans, backed by the Federal Housing Administration, our old friend, offer low down payments and easier credit requirements. They're designed for first-time buyers and those with less than perfect credit. VA loans are available to veterans and active military. Zero down payment required. No private mortgage insurance. A benefit earned through service. USDA loans target rural properties. Also zero down payment. Designed to encourage development in less populated areas. Adjustable rate mortgages still exist. Lower initial rates that will change later. Riskier but attractive to buyers who plan to move or refinance before adjustment. Interest-only mortgages persist too. Despite their role in the crisis, they're still available, still risky, sometimes appropriate for specific situations, often not. The market offers options. Whether those options serve borrowers well depends on whether borrowers understand them and whether lenders are honest about the risks. For those who already own, refinancing remains a periodic opportunity. When rates drop significantly, refinancing can save hundreds per month. Replace your 6% mortgage with a 4% mortgage, your payment shrinks substantially. But refinancing has costs, new closing costs, new fees. These can total thousands of dollars. The math matters. If refinancing costs $5,000 and saves $200 per month, you need 25 months to break even. Plan to move before then? Refinancing loses money. Rate and term refinancing simply changes your interest rate and perhaps your term. Cash-out refinancing extracts equity. You borrow more than you owe, pocket the difference. Cash-out is tempting, but it extends your debt, increases your balance, restarts the clock on building equity. The home as ATM mentality that preceded the 2008 crash lives on. The temptation to borrow against your house remains strong. Sometimes it makes sense. Often, it doesn't. The process of getting a mortgage has evolved with technology. Online lenders offer streamlined applications, pre-qualification in minutes rather than days, algorithms assessing creditworthiness instantly. Documents can be submitted digitally. Bank statements, tax returns, pay stubs uploaded from your phone rather than faxed or mailed. Some closings are now digital too. Electronic signatures, remote notarization. You can theoretically buy a house without entering a physical office. The pandemic accelerated these changes. What once required in-person meetings became possible from your couch. But the fundamental complexity remains. Mortgages are still intricate legal and financial instruments. The paperwork is still extensive. The fees are still numerous. Technology has made the process faster. It hasn't made it simpler. Let's look beyond America. How do other countries handle homeownership? The United Kingdom has a strong homeownership tradition. Mortgages are common and widely available, but the terms differ from America. 25-year terms are more common than 30, and interest-only mortgages are more popular, riskier products that remain mainstream. After 2008, British regulators tightened lending standards, stricter affordability tests, more documentation required, an attempt to prevent the excesses that caused the crisis. British houses are expensive, particularly in London and the Southeast. First-time buyers face challenges similar to Americans in coastal cities. Canadian mortgages look similar to American ones on the surface. But there's a crucial difference. Mortgages are typically amortized over 25 years. You'll pay off the loan over that period. But the term, the period during which your interest rate is locked, is much shorter. 5 years is common, sometimes less. This means Canadians renegotiate their rate regularly. Every 5 years, you're exposed to whatever rates are doing at that moment. When rates rise sharply, as they did recently, Canadian homeowners feel the impact quickly. No 30-year protection. Your mortgage payment can increase significantly at renewal. The Canadian system offers less stability, more exposure to rate fluctuations. Canadian homeowners pay closer attention to central bank decisions than Americans typically do. Germany presents a stark contrast. The German homeownership rate is around 50% and much lower than America or Britain. One of the lowest in Europe. Germans rent. And not just the poor. Middle-class Germans, wealthy Germans. Renting is culturally normal. Not a failure, not a stepping stone. Simply, how many people choose to live. Strong tenant protections help explain this. German renters have security, long-term leases, limits on rent increases. The precarity that American renters feel doesn't exist in the same way. When Germans do buy, mortgages require large down payments, 20% minimum, often more. Fixed terms shorter than American 30-year loans, with rates adjusting periodically. The German approach is more conservative, less leverage, less risk, but also less home ownership. Danish mortgages are fascinating. Denmark has a unique system of mortgage-backed bonds dating back over 200 years. Highly developed, remarkably stable. Here's something unusual. Danish borrowers can buy back their mortgage if rates drop. If you borrowed at 6% and rates fall to 4%, you can purchase bonds equal to your mortgage balance at market price, now cheaper, and essentially refinance at minimal cost. This provides flexibility that American borrowers don't have. Protection against being locked into unfavorable rates. Denmark has high home ownership rates and a mortgage system that weathered the 2008 crisis better than most. It's often cited as a model. Japan offers a completely different perspective. Japanese homes depreciate. This is the opposite of the American assumption that real estate always appreciates. In Japan, the building is considered temporary. It will be torn down and replaced every few decades. The land beneath is the asset. This changes everything about housing economics. You're not building equity in your home. You're building equity in your land, if you own it. Multi-generational mortgages exist in Japan. Loans designed to be paid off over 50, 70, even 100 years, passed from parent to child. The cultural approach to housing is fundamentally different. Home ownership exists, but with expectations and structures that would seem alien to Americans. The 30-year fixed-rate mortgage is distinctly American. Other countries achieve home ownership or choose not to prioritize it through completely different structures. Shorter terms, different rates, different cultural expectations. No system is perfect. American stability comes with inflexibility. Canadian flexibility comes with rate exposure. German renting comes with lower wealth building. Each involves trade-offs. The American assumption that everyone should own, that renting is failure, that real estate always appreciates, these are cultural beliefs, not universal truths. Other societies have made different choices, achieved different outcomes. Their citizens aren't worse off for lacking 30-year fixed mortgages. Understanding this context helps us see our own system more clearly. The mortgage that seems inevitable, natural, the only way, it's actually a specific historical creation, an American invention. Whether it's the best invention, whether it still serves us well, whether it needs to evolve, these are questions worth asking. The mortgage has shaped American life for nearly a century. What it will look like in the next century remains to be written. We've traveled a long way, from Mesopotamian clay tablets recording land transfers to Roman legal codes, from medieval peasants bound to soil they'd never own to homesteaders staking claims on stolen prairie, from brutal balloon mortgages to the FHA's revolution, from post-war suburbs to financial catastrophe. Now let's pause. Let's sit with what we've learned. Let's ask what it all means. The modern mortgage system, for all its flaws, enabled something remarkable: mass home ownership. Not just for aristocrats or the wealthy, but for ordinary families, teachers, factory workers, nurses, people who, in any previous era, would never have owned property. Wealth building. Home equity became the primary store of wealth for the American middle class. Families bought homes, paid them off over decades, and passed something tangible to their children. Stable communities. When people own their homes, they invest in their neighborhoods, they know their neighbors, they stay, roots grow, economic growth, construction, real estate, home improvement, furniture, appliances, entire industries built around the homeowner, millions of jobs, trillions in economic activity. The suburban middle-class lifestyle, for better and worse, was built on the 30-year mortgage. It shaped how Americans live, where they live, what they aspire to. This matters. It's real. We shouldn't dismiss it. But let's be honest about the costs, too. 30 years of debt. For most homeowners, the mortgage is the largest financial obligation of their lives. Decades of payments, decades of vulnerability. When economies stumble, homeowners suffer. Foreclosure doesn't just mean losing a house. It means losing stability, community, sometimes family cohesion. The 2008 crisis showed us how quickly the dream can become a nightmare. And the system was never fair. Racism was built into its foundation. Redlining, predatory lending, communities of color systematically excluded from wealth building, then systematically targeted for exploitation. Even today, the benefits don't flow equally. Who can afford a down payment? Who has the credit score? Who has the family wealth to help? The answers track closely with race, with class, with the accumulated advantages and disadvantages of generations. The mortgage system created winners and losers, by design, not by accident. And then there's what it feels like. For many homeowners, the mortgage is both security and burden. Pride and anxiety intertwined. There's genuine satisfaction in ownership. This is mine. I'm building something. I belong here. But there's also stress. The payment due every month. The fear of job loss. The maintenance costs that never end. The property taxes that climb. House poor describes millions of Americans. They own homes on paper, but have no financial flexibility. Every dollar goes to the mortgage, leaving nothing for emergencies, for experiences, for life. The pressure to maintain property values creates its own anxieties. Keep up the lawn. Paint the trim. Don't let the neighborhood down. And beneath it all, the fear that never quite disappears. What if I can't make the payment? What if I lose this? Ownership is not the same as security. Sometimes it's the opposite. Which brings us to the fundamental question: is homeownership still the dream? Or has it become a trap? Younger generations are increasingly skeptical. They watched their parents lose homes in 2008. They face housing prices that have far outpaced their wages. They carry student debt that makes saving for down payments nearly impossible. Some are choosing differently. Renting offers flexibility, no maintenance costs, no property taxes, the freedom to move for opportunity, for love, for adventure. Others still want ownership, but can't access it. The dream isn't rejected, it's denied. Maybe we've been asking the wrong question all along. Maybe the dream shouldn't be home ownership specifically. Maybe it should be housing security, a stable, affordable, dignified place to live, whether you own it or not. The 30-year mortgage is one way to achieve housing security. It's not the only way. And for millions, it's not an available way. Consider the paradox of where we are. We've standardized mortgages, yet housing is less affordable than ever in many markets. We've learned from past crises, yet new bubbles form, driven by the same speculation, the same greed. We've created consumer protections, Yet predatory lending persists, finding new forms, new targets. We've built a system, yet it doesn't work for everyone. Maybe it never did. The tools exist, the knowledge exists, the history is clear, and still, the gap between what is and what could be yawns wide. Here's what I want you to carry from this journey. The 30-year fixed-rate mortgage is less than 100 years old. For the vast sweep of human history, nothing like it existed. It was invented by policymakers responding to crisis, by institutions adapting to need. What was invented can be changed. Housing is a fundamental human need. How we finance access to it is a choice. We made certain choices in the 1930s. We've modified them since. We could make different choices tomorrow. Co-housing, community land trusts, cooperatives, social housing, rent control. Alternative models exist. Other countries do things differently. The conversation is evolving. Young people especially are questioning assumptions their grandparents never doubted. Maybe ownership isn't the only path. Maybe equity isn't the only goal. Maybe stability and affordability matter more than building wealth through property. Or maybe the 30-year mortgage, reformed and expanded, remains the best tool we have. Maybe the answer is making it accessible to everyone, not abandoning it. I don't know. The history doesn't give us a single answer. It gives us options. It shows us that what seems permanent is actually contingent. What seems natural was actually constructed. As you lie in your bed tonight, whether rented or mortgaged, owned outright, or still decades from payoff, consider the history beneath you. The roof over your head is the product of centuries of policy, innovation, struggle, and compromise. Clay tablets and legal codes, feudal obligations, and revolutionary reforms, government programs and market forces, triumphs and disasters. Mortgages became common because the government made them possible. They built wealth for millions. They destroyed lives for millions too. The story isn't over. We're still writing it. Every policy debate about housing, every discussion of affordability, every question about who can access the dream and who cannot. These are continuations of a conversation that stretches back millennia. You're part of that story. Now, wherever you sleep tonight, you're living in its latest chapter. Rest well. And perhaps tomorrow, think about what the next chapter might hold.